Ladies and gentlemen, welcome to today's webinar. Today's seminar presentation is The Time to Act is Now, Estate Planning in a Pandemic. Our presenter today is attorney Thomas Shaw. If you'd like a copy of today's presentation, you can find it in the handout section of the webinar interface. And similarly, if you have a question, you can type it into the question section of the webinar interface. And now let me turn it over to Tom. Go ahead, Tom.
Well, good day, everyone. I hope that you're all safe and healthy in this pandemic. Obviously, the topic today is about the pandemic, and why the time to act is now. We're going to talk about different opportunities that this pandemic presents for estate planning purposes. We'll go a little bit more into IRA planning that's also affected by that, a few cautions, and then a conclusion. So if you have any questions, as Tony said, please put those in the question box. From an estate planning perspective, this current health crisis, or really any financial crisis, in the short run can result in lower asset values. And also, as we've now seen, lower interest rates. And when that happens, they provide opportunities for assets to be transferred out of a client's taxable estate at a reduced gift tax cost because the asset values are lower, with the opportunity that in the future there may be greater appreciation that passes on to the client's beneficiaries as the economy rebounds. So I know a lot of our clients have been calling their stockbrokers and financial planners, but not many have been calling their estate planners and saying, hey, my asset values are down. These are assets I've been trying to get out of my estate. What are the opportunities? And then in the background behind that as well, there is a good chance that the current estate tax exemptions are not going to stay in place forever. We know that the law by its own action in 2026 cuts the estate tax exemption in half. And with all the spending that's going on with the federal government right now, there will be a lot of pressure to perhaps even lower it more. So it makes sense to do some of this planning now because of what we think the future is going to hold, as well as the fact that asset values are lower. So having said all that, the stock market has actually recovered almost all of its losses since the pandemic started. And so, for example, the Dow Jones in February 1st, it was trading at about 29,000. It dropped about a third by the end of March and was at around 19,000. But as of last week, it was back up to 26,000. So it's recovered quite a bit of its value. The same with this S&P. It was at 3,200. It dropped about a third to 2,200, and now it's trading back around 3,100. So the question that comes to mind is, why are we still holding this seminar? The market's recovered. The assets aren't lower. So what's the point? Well, there's a couple of points. First off, estate planning is always a good idea, particularly, as I said before, when we know the exemption is going to drop in half in 2026. And I say we know that, we don't, but it would require an act of Congress to change it and a president who would sign it. And so I'm not sure that we're going to be in a situation where Congress is going to act to keep the exemption at its current high rate. But the other reason for still acting now is that not all stock classes have recovered. I'm sure if you look at hotels and airlines, for example, and other tourism-related industries, those stocks haven't recovered. And similarly, if you have a privately held business, and particularly if it's in the kind of an industry that's affected by what's been going on, and as an example, here in Central Florida, there are a lot of businesses that are tied to the movie industry. Into the amusement park industry. Well, those amusement parks, some of them haven't opened back up, and the movie industry is just starting to reopen. So businesses that serve those industries might not be worth as much today, even though the stock market is recovered. The other reason we're to still look and consider these opportunities is that interest rates are still low. In fact, they are historically low. The rate we use, we call the 75/50 rate, is 0.6%. I mean, that's as low as it's probably ever been historically. And for an example, in January, just 6 months ago, the rate was 2%. So we've seen the rate drop by more than 50%. So sometimes when you have low rates, that makes the different estate planning techniques we're going to discuss today work a little better because you don't have this internal load of trying to get a rate of return greater than the IRS rate. For the next few minutes, we're going to go through several opportunities. I'll try to give some technical explanation as much as I can, but there are a lot of techniques, and so I don't want to get bogged down. So for example, a GRAT right now is a great opportunity in this current environment. A GRAT's an abbreviation for Grantor Retained Annuity Trust, and basically what the donor, the person, the client does is they take an asset, they put it into an irrevocable trust. It's called an annuity trust or a GRAT trust. They retain for themselves. That's why it's called a grantor retain. The grantor retains a life interest for, they retain a lifetime interest for a certain, usually for a set number of years. And the goal is to pick a number of years far enough out to press down the gift of the remainder for gift tax purposes, but at the same time, be fairly certain that you outlive the term so that the asset is out of your estate. Now, normally when you retain an interest in an asset, it will be included in your estate. And that would be the case if you die while you still own an asset. But once the annuity ends, then the asset's no longer in your estate. And because you can do it where you're leveraging the gift value by lowering it, by keeping your own interest, the amount of gift is lower. And so over the long run, more assets get out of your estate, because once you transfer it into the GRAT, that locks in the price. And if you outlive the term of the GRAT, then the remainder will go to your beneficiaries, and all the appreciation during the term of the GRAT also goes to your beneficiaries. And all of that, the asset and all its growth over the term of the GRAT, is outside your estate. And you do that at a discounted gift tax, use of your gift tax exemption. So again, if you die during the term, it's not the end of the world, but you do lose the cost of setting it up. Because right now, if you do nothing, the asset's going to be in your estate, including the appreciation. If you have a client who's in a high-risk category, for example, someone who was in a nursing home or had had some of the other factors that cause the COVID-19 virus to be more lethal, for example, a smoker or have pulmonary issues or heart issues, this might not be the concept for them. Again, as I said a little earlier, the nice thing about an annuity, which is a GRAT is a type of annuity, is that the asset's appraised at the beginning, and it doesn't have to be revalued each year. So that means the benefit of the lower values and the interest rates are all locked in over the term of the GRAT. And so just to give you an example, if you were to take so let's take an airline stock that's was worth $100,000 in January. After the pandemic hit and the markets hit, the stock dropped to say $75,000. That's an ideal asset to put into GRAT, because we're pretty sure if it's a good airline that it will survive this and its value will come back. And so all of that $25,000 differential would end up going back to your remainder beneficiaries. It's also possible there may be some discounts you could get on that value, so maybe the gift would be even less. So for a taxable gift, on this example of maybe $25,000 to $30,000, and lifetime payments back to you as the client, as the grantor of another $25,000, the children who are typically the beneficiaries of a GRAT remainder interest, they'd receive $90,000 asset at the end of a 10-year term. So that's just an example of how, because of the leverage of the fact that the prices are low and interest rates are low, that you're able to get a lot of assets out. In this case, in this example, $90,000 out to your beneficiaries for an estate tax exclusion use of $25,000. So you've gotten almost 4 times the value out for what it costs in your exclusion. Another concept would be a CLAT, which is a charitable lead annuity trust. And this is not your typical charitable trust. We're used to talking about charitable remainder trusts. This is a trust where the charity gets the interest first for a set term, and then the remainder goes to your beneficiaries at the end of the term. Because you're making a gift to charity, you do get income tax and a gift tax charitable deductions. And as a result of the charity's interest at the beginning, the remainder that goes on to your family that gift to your family is much smaller. And so again, it's an annuity, so there's no ongoing annual appraisals, and you can even zero out the gift, so there's no gift at all. So to give you an example, to use the same $100,000 of airline stock that we talked about earlier, again, today it's worth $75,000. We set up a 10-year CLAT. If your kids are in their mid-60s, the remainder at the end of that 10-year period would be about $36,000, and you'd get about a $39,000 charitable deduction. So as with all charitable concepts, it does require the client to be charitably inclined, because in this example, the asset was $100,000, but it was gifted at $75,000. The children do end up with $36,000, but if you notice, the charity also got $39,000. So you have to run the numbers and then also be willing to make sure that there's going to be something going to charity. Also in this example, you might, for example, make a commitment to a university that you're going to pay them X dollars for 10 years, and they'll name a hall or building or something after you. Well, the charitable lead trust will let you do that, knowing at the end that the remainder is going to go to your children. Now, another concept, and this is not fancy at all, but it's just to make annual exclusion gifts to your family. Each person is allowed to give $15,000 per person per year in gifts, and there's no gift tax return required. So if you have a client and they have 3 children, they can give each of those children $45,000 a year, no gift tax return, and their estate is reduced by $45,000. So if you have this airline stock that's down by 25%, that means that you can actually give what in real value, or what you think will be the future value, of maybe $18,000, $19,000 per person per child. But at today's valuation, it's considered $15,000. And so in just a few months, that might jump back up to $19,000. So again, it's a good way, using the market's downturn, to leverage what you gift out. This is also an opportunity to consider making gifts of stock if you're comfortable giving the stock directly to your children, or if you have trusts set up for your children, stock in a closely held business, or to recapitalize the business to voting and non-voting stock and give non-voting shares to your children, to the trust for your children. And again, you get the leverage of the market being down because the business is worth less currently. Now, in my example earlier, if you have a client who has 3 children and the client's married, they could give $90,000 per year, each of them giving $15,000 per person out of their own money. If you have, for example, a closely held business that's just in the name of one spouse, you may need the other spouse to join in the gift. And in that case, the spouse can join in and give the full $90,000, but there'll have to be a gift tax return filed. So another concept, and I started to allude to this just a moment ago, is this might be a good time to set up or to add to irrevocable trusts. And there are a lot of different kinds of irrevocable trusts. You may already have, for example, a life insurance trust that you have set up that every year you fund X thousands of dollars into to pay the premium each year. And normally you do that in September when the bill comes. There's nothing to stop you today from transferring assets into the trust. Let the trust sell those assets, use the funds to pay the premium, or to just sell it yourself at the lower value. Anyway, you can fund things now. You don't have to wait. Similarly, you could do an intentionally defective grantor trust, which work well with the low interest rates. You might do a spousal lifetime access trust, where you set up a trust for the benefit of your spouse, and then on to your children. And you can't, as a grantor of the trust, you can't access the funds, but your wife could take out the funds if the husband set up the trust, and the wife, in effect, could share those funds with the spouse. So there's a lot of different things you can do like that, where you start to fund your irrevocable trusts. This is sort of a general catch-all, because as we've already been talking, the CLAT is a type of trust, the GRAT is a type of trust, but it just makes sense to stop and think about other trusts that you're funding, and could you fund them with assets that right now are lower in value, but over time will appreciate again in value. The next technique here is not really it's not really an estate planning technique per se, because when you make loans to family members or to trusts for family members, you still have the asset of the loan. But the reason I put it here is because you may have made loans to your family members and you have made the loan at the minimum rate, which might have been 2% in the past, or it might have been 4%, or you may have used a market rate. But the rate you have to use now is so low that it might make sense to refinance those loans or to make some loans now that might help your children buy a home or start a business or just make it through a COVID emergency. Normally when interest rates are low, a QPERT or a qualified personal residence trust is not typically recommended. Basically, a qualified personal residence trust lets you set up a trust, transfer your home, or if you have a second home, a vacation home, either one, and you can also do two trusts. You can do one for your home and then one for your vacation home. And then again, you retain the right to live in the home for a set number of years, and then at the end of that term, the trust goes on to your beneficiaries or to a trust for your beneficiaries. And typically, you'll retain a right to continue to lease the home at fair market rate, so you don't actually have to leave when the term ends. But now the house is out of your estate, and all the appreciation and the value of your home is out of the estate. So the low interest rates, it doesn't work as well. But if real estate rates start to fall, and I did read one thing recently that talks about where rates were down about 10%, or the value of assets were down about 10%. If real estate values do fall, then it might make sense to look at a QPERT, particularly for older grantors, where you can sort of work against the actuarial tables. If you have grantors that are older, but are in really good health and their parents lived a long time, that maybe they would be a good candidate even though they're older, because the value of the real estate's dropped. You still get some leveraging on the QPERT even though the interest rate's not going to help you. Another factor that's, again, not really estate planning, but if you're expecting income in the future when the economy rebounds, you might actually lock in some of your losses on some of your assets so that you take some tax losses now, which you're going to deduct against your future income. So that's this isn't all of the concepts, but I wanted to shift a little bit to IRA planning because there's been a lot of changes in the law relating to IRAs, not only just general changes in terms of how you make IRAs payable to your beneficiaries, but there was also some changes this year that relate to how you can handle IRA distributions and that sort of thing, and those are related to the pandemic. And there are in there also some IRA planning that is related to estate planning. We will talk about those, but I just wanted to make sure that people are aware that in the 2019 Secure Act, which was effective January 1st of this year, the lifetime stretch out for children and grandchildren with 5 exceptions has been eliminated. And so now if you've done planning with your IRAs where you're running it through a trust, and in that trust, you had intended for the trustee to distribute the IRA over the life expectancy of the beneficiary, that rule has been changed, and now it's a 10-year payout unless you fit into one of the 5 exceptions. Also, just for context, the default rule is 5 years. If you don't fit into an exception somehow, the default rule always was that the IRA had to be paid out over 5 years. So for example, if you name your estate the beneficiary by accident, of course, or you name someone who doesn't qualify, then you could end up like an entity. You can end up with a 5-year rule. Most people did the planning right. They had beneficiaries who qualified for the lifetime stretch out, it was called, and so they didn't worry about it. Now they need to worry about it because that life expectancy stretch out could be shortened to 10 years. And it could end up accidentally being rushed out all at once in the 10th year when people realize that the new rule applies. And then you'd have this huge amount of assets that are all income taxable in that year of distribution. So before, where we were stretching out the income inside an IRA over the lifetime of say, the children, which might be 20 or 30 years, now it's getting compressed into 10 years. There are some exceptions. The traditional rules we all know about transferring to a spouse, either outright or through a trust for the benefit of the spouse, those still apply. The spouse can still treat it as an inherited IRA. They can roll it over and treat it as the spouse's own IRA, and then start taking distributions out over the spouse's life expectancy, which probably is longer since that is the surviving spouse. The other exception that's a newer one is that you can transfer to someone within 10 years of the owner's age. And this basically covers where the owner wants to transfer it to his or her brother or sister, who's usually within 10 years of age, or to a living girlfriend or boyfriend, again, who's oftentimes around the same age. There is an exception for transfers to minor children, but this is a very narrow exception because typically our clients, their children are minors, and it can only be the children of the account owner. And it's also a temporary one. So once the child reaches 18, the 10-year rule kicks in. So if a child inherits an IRA at age 2, the exception will apply until the child reaches, in Florida, 18. So there will be a 16-year delay, but then at 18, there'll be the 10-year rule kicking in, and that IRA has to be distributed before the child reaches 28. So this is quite a change in the law, and people need to be aware of it because it may affect their planning. There may be an extension to age 26 under federal law. The law seems to say so, but it's a little bit of a surprise. And again, it doesn't apply to grandchildren or other people who aren't the children. So it's very narrow. The other two exceptions are if you're a disabled person, which basically means that you cannot carry out at least 2 of the 5 typical activities of daily living, such as bathing, dressing, feeding, transferring, toileting, and continence. And then the last exception is someone who's chronically ill. And the definitions in the statutes basically say you can't keep a job because of this illness, and the illness is likely to kill you or to have a very indefinite duration. So those are the exceptions. If you have a beneficiary who fits one of those exceptions, then you can do trusts providing for the lifetime payout, just like we've always done. But note that you can't mix the people. So if you have one child who qualifies as disabled and 2 children who are not, the client's going to need to do at least 2 trusts, one for the disabled child and 1 trust for the other children. And the trust for the other children is going to have a 10-year rule, but the trust for the disabled child could go for a 10-year payout. And so it may make sense to do that kind of planning, again, using lower valued assets right now. And also, everyone's jumping around trying to say, what do we do? What do we do? Well, a 10-year stretch out still may make sense because that's better than a 5-year or all at once. If you give an IRA outright to someone, the 10-year rule applies to them. They can still take it all out in year 1. It'd be bad tax planning, but they could do that. So sometimes a trust, even if you're only getting 10 years, is better than none at all. And maybe the law will change again and they'll go back to that. So there are also some other things under the Secure Act. It changed the rule that you don't have to start taking required minimum distributions over your life expectancy until age 72. So that gives you an extra year and a half. But it may be better to take some out now. You'd have to sit down with a spreadsheet and try to do some calculations. But asset values are lower now. So maybe it's better to take it out now, pay less income tax, especially if you're in a higher tax bracket. Take it out now, pay less income tax than you would pay if you took it out later, especially if later you think you're going to have you're going to still be in a high tax bracket. The other thing the Secure Act does is it lets you delay by 1 year if you're forced into the, if you inherited an IRA from 2015 to 2020, you get an extra year. But it may make sense not to wait that extra year. So let's see, I'm sorry, I lost my track. So the other thing is that you may consider, and hopefully I can explain this carefully. The way the Secure Act works is that there isn't an age limit on IRA contributions. And so it may make sense if you have a client who has income now to set up an IRA, but fund it with these lower valued assets, knowing that if you put in the airline stock at $75,000, that your account is probably going to be worth $100,000 by the end of the year or by the middle of next year. And so you will have put in $75,000, but gotten an asset that's basically going to be $100,000 inside your account, now growing income tax free for when you take it out in the future. So I want to talk about some pandemic opportunities that are tied to IRAs. And so one is to consider making your IRA payable to a charitable remainder trust. This is not a new concept. The idea of paying an IRA to a charity is not a new concept. A lot of people do it, and they do it because they don't want anyone to have to pay the income tax on their IRA. And by donating their IRA to the charity, there's no income tax. Now, instead of that, my suggestion is consider doing a charitable remainder trust, which is you put an asset in. There's a lifetime benefit that comes back. It could come back to the IRA owner, or it could go to beneficiaries, say the IRA owner's children after the IRA owner died. And then at the end of the lifetime of the children, then the remainder would pass to a charitable remainder trust. And the reason you might do that is because you're leveraging with lower valued assets, and you're creating a lifetime payout. Because one of the problems we talked about earlier is the new IRA rule says you can only have a 10-year payout on your trust. So here we're saying, well, let's just move this over to a charitable remainder trust, have the lifetime payout to my children, so they're going to get this flow of income for their lifetime, which will help them through their retirement. And then at their later death, then it goes to charity. So they got the lifetime payout. As I mentioned before, the remainder is going to charity. So there isn't this future benefit going on to the next generation. And so like I'd said before, you have to have some charitable inclinations because the remainder isn't going to stay in the family. But there is going to be this huge benefit to charity at the end. And so there's a couple ways to do charitable remainder trusts. We call them CRTs, but there's the CRAT, which is a charitable remainder annuity trust. And like I had said before, because it's an annuity, you value the asset once and you lock in all of the numbers and interest rates. And that's very helpful, particularly for a hard to value asset. The alternative is a charitable remainder unitrust or a CRUT. It pays a unitrust amount, which is basically a percentage of the value of the assets in the trust at the end of the preceding year. So with a CRUT, you have to be able to revalue the asset every year. So you wouldn't want to do something that requires a lot of complicated appraisals. You would want an asset, for example, publicly traded stocks, where you could just go check the market, figure out what the value is, and that would establish your unitrust payment for the coming year. As an example, if you had $1 million IRA and you paid it and you set it up in an optimized form so that it benefits the account owner's children, and let's say they're in their early 60s, and the fund is growing at 5%, which is fairly conservative. That CRT would pay out $1.9 million approximately to those children over their lifetimes. So double what's in the IRA today. And then at the end of their lifetimes, there would be another over $600,000 going to charity in the grantor's name. So again, if you're charitably minded, you've now done something where you provide a huge benefit to charity, but in the meantime, you provide it for your own children over their lifetimes, where they've been able to take out $2 million from what today is $1 million IRA. Another concept is consider converting an IRA to a Roth IRA. And this takes a little spreadsheet calculating to see if it makes sense. But basically the idea is you are paying income taxes now when the value of the IRA is likely lower due to the market drop. And so you're going to pay less income taxes now than you would pay in the future. And again, you take this income tax hit today, knowing that your asset values are going to go up and you're going to have a bigger pool of funds in the future. And as a Roth in the future, the distributions under current law aren't taxable. And so you would be able to take these later distributions tax-free, and you would have leveraged them with lower value assets. So, but keep in mind, even if you convert to a Roth, when your children inherit that, if that's how you set it up, the client's children are going to have to take their distributions over 10 years. They just won't owe income tax. So you can think of it as an extra gift to your family that you're going to pay the tax now out of your assets, lower the total size of your estate by paying that income tax, and then provide a tax-free asset or tax-free asset to your children or other beneficiaries later. Yeah, that's about all there. Then there are some very, very narrow exceptions. You might consider taking a coronavirus distribution under the 2020 CARES Act, but you do have to have been affected by the virus. You know, there has to be a reason why you're taking the funds. They have to be related to the coronavirus. Now that can mean because you were put out of work or furloughed because of the quarantine, you had reduced work hours because of the pandemic, you had to stop to take care of your children or a spouse who was ill with the virus. The reason you might consider this distribution is there's not a 10% penalty on the distribution up to $100,000, even if the account owner is under 59 and a half. Now the distribution is subject to income tax, but even there, it can be reported in 3 installments over 3 years, and the funds can be returned. And if they're returned, then there's no income tax on the funds. So if you fit that definition, it might make sense to do the distribution. But again, it's only if you fit into that. Now, you can also, those same IRA rules also apply with 401k plans. The old rule of 50,000 or 50% cap on taking a loan has been increased to 100,000 or 100%. But you have the same rules that they have to be related to coronavirus. You can return it. You can spread the income tax out over 3 years, and you can return it if you return it within 3 years. So all of that said, and as I said at the beginning, it always makes sense to be looking at estate planning concepts and figuring out how to reduce the size of your estate, if you can do it in a way that meets your own financial goals, provides security for your family, and then reduces estate taxes. The purpose of this seminar is to point out some ways that are the more typical estate planning concepts for reducing your estate. These kind of concepts we were going to be talking about over the next few years anyway, because as we got closer to 2026 and it became clearer that the estate tax exemption was going to be cut in half, clients who were over 11 million total in their estate, 11, 12 million total in their estate, were going to need to do some planning to get their estates back down below 12 million. So we were already going to be doing GRATs and charitable remainder trusts and other types of trusts anyway to reduce the size of the estate. Also to use up that exemption before it goes away. Because if you use up that extra $11.58 million exemption before 2026, you'll lose it if you don't use it by then. So all of this planning was always going to be done and need to be done over the next couple of years. The difference is asset values are lower, and in some people's specific situations, depending on their portfolios or the type of closely held businesses they own, they were going to be able to get more out because of the leveraging of asset values are depressed right now, and then they're going to go up over the next 6 to 12 months. So if you do it now, and then the values go up, you've gotten even more out of your estate, and so there's even less estate taxes to pay. Also, as I said at the beginning, we're pretty sure there's going to be some pressure to lower even the $12 million exemption, the $6 million per person exemption come 2026 to even lower if it's needed for tax revenue to cover government spending. That all said, it's very important not to avoid an it's on sale mentality and put too much of these assets into these techniques, because of course once they're transferred, these are basically irrevocable transfers, and the client could get buyer's remorse that, you know, wait a minute, I transferred so much in assets that they didn't come back quite as much as I thought they would, or other things have happened, and now I'm having an income problem. I'm having a cash flow to maintain my lifestyle. The other thing is it's always possible the economy and the stock market with it are going to relapse or crash. Just as none of us predicted in January that the market was going to drop by 33% 3 months later, we don't know what's going to happen in the fall. And so it's always possible the market's going to crash again. And if it does, then then we might feel like we've done these techniques, but now we need those assets to live on. So there's going to be a little trade-off. That's why you don't want to go, treat everything like it's a sale. And so instead of getting one, let me buy two because the price is so good. It might make sense to do one technique, knowing that you're just hedging your bet and mixing your assets. The other thing is that a lot of these techniques have trustees, and trustees are often concerned about preserving assets. And so if the market is a little unstable over the next 6 to 12 months, that puts a lot of pressure on your fiduciaries as they hold these assets to decide, well, do I liquidate this stuff even though I might lock in a loss because I'm afraid the market's going to drop even more? So again, these concepts have to be looked at carefully, the numbers run, and then decide if it makes sense. So in conclusion, we're a little past the time to act right now if you mostly have marketable securities. But as I said before, it's not true for all of the stocks in a portfolio. And if you have a closely held business, it's definitely not the case. And then the other thing is if you start looking at these concepts now with the idea that you're going to have to do some of these ideas before 2026, you would be ready when the market drops again. So it makes sense to look at these techniques and to decide if it works for you as you do some planning. And as you do that planning, a lot of times these trusts also provide for your children protection from creditor claims, protection from their own financial, incorrect decisions about how they handle their finances because it's in a trust rather than outright to them. And then there's obviously planning, and then it keeps those assets out of your children's estates as well. So they're not having to deal with estate tax issues on assets they inherit from you.
Ladies and gentlemen, that's Tom's contact information if you'd like to reach out to him. Thanks so much, Tom. We really appreciate the presentation.
You're welcome.